Let me start this video with a simple math challenge. If a stock gave 1,150% return in 12 years and then 2,500% return in the next 20 years, how much do you think the total return would be in 32 years? Our linear mind might say 3,000% or maybe 6,000%, but the real answer is 32,000%. That's a 19.8% CAGR over 32 years. And that's the power of compounding. Since its IPO in 1994, Copart has delivered a total shareholder return of 32,000%, and that's even after the stock recently declined by 40% in 2025. If that decline had not happened, the return would have been closer to 51,000%. In the same period, the S&P 500 delivered roughly 2,500% with a CAGR of around 10.7%. And yes, 19.8% CAGR is not even double of 10.7%, but the outcome is wildly different. Here's how. If you invested $10,000 into the S&P 500 32 years ago, you'd have around $260,000 today. But if you invested that same $10,000 into Copart, you'd have around $3.2 million. That's the difference a roughly 9% CAGR gap can make over decades. So today we'll break down Copart, this multinational provider of online vehicle auctions and remarketing services for insurance companies, rental fleets, finance companies, and more across 11 countries. Here's the roadmap of this video. We will first discuss stock performance and valuation, then operations and why it's a hidden system business, then financial analysis from the latest annual report, then Copart comparison with its arch rival IAA or RB Global, and why this is where the real story is. Finally, we will do conclusion and outlook. Let's start with valuation. If you look at Copart's historical PE, since 2017, it has mostly stayed in the 30 to 40 range. Right now, it's trading closer to 24, which suggests the stock is discounted compared to its own history. Now, some people will say 24 is still a high PE, but I strongly believe every company earns its own valuation range. If a company has consistently traded at premium multiples for years, it's not realistic to expect it to suddenly fall to the market average PE unless something breaks. Now, the PEG ratio is around 1.6, and historically it has ranged from 1 to 3, with a mean around 2. So it's not at the dream bargain level, but again, it is below its long-term average. Based on EPS expectations, Copart's EPS is expected to grow by about 4.4% in 2026 and 8.6% in 2027. So here's the implication. If the stock price stays low while earnings keep growing, even modestly, then the PE mechanically falls further and Copart's valuation may become even more compelling in the future. Price to book matters for Copart because of its massive property footprint. Historically, price to book has been around 6 to 7 and it peaked around 11 in 2020. Now it has dropped to about 4, near a historical low. So even though the stock dropped by around 40%, the valuation relative to book value has compressed even more dramatically by 65%. Another way to say it, investors used to pay $6 for every $1 of net assets. Now they're paying just around $4. And remember, a major chunk of Copart's net assets is junkyard property recorded at cost, not revalued market price. So the true economic book could be higher, which would make price to book look even cheaper. If you look at the chart, the stock ran up for years and reached around 63, then dropped to around 34, a decline of about 47%. It has recovered somewhat to around 40, but the bigger signal is this. For a long time, Copart's price respected the 20-week and 50-week moving averages. But this is one of the first times in its long history that it's been below the 200-week moving average. That typically puts a stock in the zone where long-term investors at least start paying attention. Regarding dividends, bad news for dividend lovers, Copart does not pay dividends. If you're finding value so far, consider subscribing. It helps YouTube recommend you more high-quality investing content like this. Quick disclaimer, this is not financial advice. Regarding moat, Morningstar categorizes Copart as having wide economic moat. Similarly, Guru Focus gives it 8 out of 10 in moat strength. A few major shareholders of the company are Vanguard holds around 10.24%, BlackRock holds around 6%, founder Willis Johnson holds around 5.75%, management collectively holds around 9.6%. Now, a quick but important founder story. Copart was founded in 1982 by Willis J. Johnson, starting with a single salvage yard in California, and it grew into a roughly $47 billion global online auction giant by reshaping the industry into a tech-driven, transparent, and efficient model. He served in Vietnam and earned a Purple Heart, so his story isn't a typical Silicon Valley founder narrative. In the early days, he sold his house to fund a junkyard and moved his family into a small trailer on the property. And his key contribution wasn't just opening a yard. He changed the model from a local, offline salvage business into a scalable marketplace, pushing online bidding early before online auctions felt normal. In 2009, Copart leadership even structured compensation so that the founder and CEO gave up cash salary and bonuses for 5 years under an equity-heavy plan, basically signaling, we win when shareholders win. During COVID, Copart stayed open as an essential business and didn't lay off or furlough workers. Forbes termed it as a major differentiator. And that period was after he stepped down as CEO, but he was still chairman of the board. Copart began in 1982 in California, went public in 1994, and was later reincorporated in Dallas, Texas in 2012. Today, it operates across 281 locations in 11 countries: the US, Canada, the UK, Germany, Spain, Finland, Ireland, Brazil, the UAE, Oman, and Bahrain. They've opened 12 operational facilities outside the US in the last 3 years, which signals continued global expansion. Copart mainly acts as an agent, earning fees like auction fees, transaction fees, storage, towing, transport, title services, and other add-ons. But in places like the UK, Germany, and Spain, they sometimes act as a principal, meaning they buy the salvage vehicle and resell it on their own account. The biggest suppliers of vehicles to Copart are insurance companies, around 80% of supply. Remaining supply comes from rental fleets, dealers, finance companies, and others also contribute, but insurance is the core engine. About 70% of all auto insurers sell total loss vehicles through Copart's platform, and Copart processes vehicles from hundreds of sellers. No single customer is more than 10% of revenue, meaning the business isn't hostage to one big client. The primary buyers include dismantlers, rebuilders, repair licensees, used dealers, exporters, and the public. And Copart has a huge buyer network, around 1 million registered members. After the vehicles are auctioned from Copart, many of them are repaired and returned to the road. Others are dismantled for parts, and some are scrapped and returned to raw materials. How does an insurance company decide if a car becomes a total loss? First, the vehicle gets towed to storage or repair. An adjuster inspects it, estimates repair costs, and calculates the PAV, pre-accident value. Then they compare repair cost, salvage value, and PAV. If the cost to repair is greater than the PAV minus the salvage value, the vehicle is generally classified as a total loss, the claim is settled, and the insurer routes the car into auction. So, how does the actual auction work, and why is it better than a traditional physical auction? Copart's auction backbone is its internet auction tech called VB3. VB3 runs a 2-step process: preliminary online bidding during preview, like eBay style, where buyers enter max bids, then a live internet-only virtual auction where bidders compete in real time, and the system bids automatically up to the max. The benefit of this virtual platform is massive. It expands the buyer pool globally, creates more competition, can increase what buyers pay, and avoids the costs and capital requirements of traditional live auctions. One stat makes this intuitive. Out of 100 units auctioned in the US, around 30 are bought by buyers from the same state, 31 by other US states, and 39 by international buyers. And as the dollar has devalued by 10% and freight costs have dropped by over 20% last year, that reduces landed costs for exporters, which can improve demand from international buyers. So, who are the competitors? Competitors include the infamous RB Global, IAA, Carvana, OpenLane, Manheim, and ACV Auctions. An LKQ, American Recycling Association, and similar dismantlers may purchase salvage vehicles directly from insurance companies, thereby bypassing vehicle remarketing companies like Copart entirely. Finally, few things that affect total loss dynamics. Total loss frequency rises when repair costs rise, labor rises, parts get expensive, and technology complexity increases, especially with advanced electronics and specialized components. If resale values fall, that also increases total loss probability. For these reasons, the new tech cars are getting totaled easily. CCC's Crash Course notes hybrid total cost of repair has risen much faster than EVs since 2020. That is 51.5% more for hybrids versus 19.1% more for EVs. They also report that vehicles for which an appraisal was written were flagged as a total loss has risen from 9% in 2000 to 23% in 2025. One more interesting factor is that company says they get 5 to 20% more vehicles during winters, so the recent winter wave might also help them this year. And the EV transition creates both friction and opportunity. People think that EVs don't have that many parts, which may affect companies like Copart in the future, but EVs still contain high-value components like batteries, drive units, inverters, screens, lights, and more. Also, transition to EVs and then getting to average life of a vehicle can take decades. Regarding employees, as of July 31st, 2025, they had 11,600 full and part-time employees, of which 64% were located in the US and 36% were located within international segment. Auditors are EY, and they didn't disclose any critical audit matters. They've been the auditors of the company since 2006, good long-term relationship. Balance sheet, Copart's year-end is July. Total assets are around $10 billion, and roughly $4.8 billion, almost half, are cash and short-term investments. Property is around $3.6 billion. We have discussed property in other sections. Goodwill is relatively small, around $0.5 billion. Even though Copart processes huge vehicle volumes, inventory is only about $40 million because most of the time they operate as an agent, not as a principal holding vehicles. On the liabilities side, there's no long-term debt and total liabilities are only about 9% of assets. Retained earnings are about $8 billion, showing how much profit has been retained and compounded internally. Current ratio is around 8.4, which is extremely strong. P&L service revenue is about 85% of total revenue. Revenue growth is about 10%, but operating income growth is about 8%, mainly because facility operations and G&A grew faster than revenue. Net interest income expanded sharply because Copart has so much cash, helping net income grow faster than operating income. Yes, if interest rates decline, that tailwind could fade, but it may be offset by rising cash generation. Across 9 years, revenue has increased consistently in all categories with a major push in 2021 and 2022. Vehicle sales are only 15% of revenue, but US vehicle sales have grown faster than service revenue, which is why vehicle sales were only 11% a few years back. Operating income has grown faster than revenue overall, which is positive operating leverage. Margins peaked in 2021 and drifted down since. One of the most interesting insights, in 2025, US operating income increased by about $53 million, but international increased by about $72 million, meaning international delivered about 58% of the operating income increase while being only 17% of revenue. That tells you international is becoming more strategically meaningful. Cash flow. Operating cash flow increased from about $1.36 billion to $1.8 billion, and cash conversion is strong. Operating cash flow is around 1.16 times of net income. Capex increased from about $516 million to $569 million, showing Copart is reinvesting a meaningful portion of cash back into capacity. Tax payments jumped to about $409 million, but this payment relates to last year's liability. This year's liability is lower than this. ROCE declined from around 28% in 2022 to 18%, even though profits rose. One explanation is that cash is accumulating so quickly that it becomes harder to deploy it at the same marginal return. So returns compress as the asset base swells. Financial conclusion. Copart is cash-rich, debt-free, highly liquid, and still compounding, but it's also reaching a scale where deploying incremental capital at the same historical ROCE becomes harder, which is why investors may start expecting dividends or buybacks eventually. This video is incomplete without comparing Copart to its rival Insurance Auto Auctions, now part of RB Global. These two effectively form a duopoly, representing around 70 to 80% of the market. Now, the shocking comparison. Copart trades around a PE of 24, while RB Global trades around 48. Copart's PEG is around 1.6, while RB Global's is around 4.2. So valuation-wise, Copart is far cheaper. Performance-wise, Copart has outperformed RB Global by around 1,300% over 20 years and massively outperformed long-term. But in the short term, especially after Copart's recent 40% decline, RB Global has looked stronger. Revenue is similar, both around 4.5 billion, but profitability is not even close. Copart's net income is around $1.6 billion, while RB Global is around $413 million. So Copart earns roughly $1 billion more net income on similar revenue. Why? Two big reasons. Copart operates at a dramatically lower operating cost. Also, RB Global pays around $200 million in finance costs, while Copart earns around $170 million in interest income because it's sitting on a mountain of cash. Now let's talk about the real moat: land. Copart holds about 19,000 acres of real estate. About 17,000 acres, which is around 90%, is owned and 2,000 acres is leased. RB Global holds about 13,500 acres, but only 5,400, which is around 40%, is owned, and 8,100 is leased. That difference is massive. Copart's land is recorded at a cost of around $2.4 billion, and capex runs about $400 million annually, while RB Global's owned land is only around $600 million. That is only 1.5 times of Copart's annual capex. This matters because the business isn't just digital, it's physical. You need yards, storage, processing, towing capacity, and surge handling. Copart even keeps 25% of its land idle to absorb sudden disasters and supply spikes. It also has more towing capacity and better ETA service delivery. So insurance companies prefer the platform that can handle normal flow and disaster surges. Now here's the hidden value angle. Copart's property is carried at cost. Average cost per acre is about $140,000. But if market value is conservatively $200,000, that implies roughly $1 billion of unrealized gain. If market value is $300,000, unrealized gain becomes about $2.7 billion. That's like 1.5 years of net income hidden inside the books, waiting for the right time. Then the final hammer. Copart is debt-free, while RB Global has long-term debt of around $2.6 billion. Copart already has about $5 billion in cash, and given its profitability, it has incredible optionality, such as expansion, acquisitions, land purchases, or eventually buybacks or dividends if they want to. So if you step back, you start asking, how is the debt-free, cash-rich, land-heavy, high-margin leader trading at half the PE of the leveraged competitor? That seems to be the market being irrational, and that's exactly where opportunity can exist. Now, I'm not saying RB Global is a bad business. Some insurers prefer them. Progressive favors RB Global, and as Progressive is growing its market share, that benefits RB Global volume as well. RB Global is also expanding internationally. And at the moment, unit growth might be flat, and RB Global is even gaining market share while Copart is losing some. But even if both are good businesses, Copart is simply much cheaper today, while also being structurally and financially stronger. So here's the big picture. After a major decline, Copart's downside from here appears limited, while upside potential remains strong because it's debt-free, cash-rich, globally expanding and positioned in an ecosystem where total loss dynamics, repair inflation, and complexity can continue to support supply there. There are macro tailwinds too. The online vehicle salvage market is expected to grow through 2030 at 14.6% CAGR. Vehicle miles traveled have increased massively over decades. Tech upgrades can increase driving and vehicle usage, and migration from dense to less dense states increases per-person vehicle miles traveled. According to the U.S. Department of Transportation, vehicle miles traveled have increased about fourfold since the 1960s. And with every wave of technology, driver assistance today and more autonomy over time, driving keeps getting easier and more convenient, which can push miles even higher. There's another quiet tailwind too. Migration. People are increasingly moving from dense states to less dense ones. On average, the states people are leaving have roughly 475 people per square mile, while the states they're moving to average closer to 146. And when you live in a less dense place, you naturally drive more. In fact, average annual vehicle miles traveled is about 7,800 in the first group versus 11,200 in the destination group, roughly 44% higher per person. Also, Copart's large cash stockpile creates a wildcard catalyst. Buybacks, dividends, acquisitions, or strategic expansion, any of which can reignite investor excitement. So if someone believes Copart is a fundamentally solid compounding business, this looks like a period where it's trading near a historical low, and that's often where long-term positions are built. If you like this video, subscribe. It helps the channel grow and helps YouTube recommend you similar content. Thank you for watching. See you in the next one.